Hello, America. My name is Dylan John, and you are listening to Nature and the Nation. And for today's episode, I'll be looking at Free Trade Doesn't Work by Ian Fletcher. My book here is the 2011 edition. This first came out in 2010. I don't think the 2010 and 2011 versions are probably not all that different. It's a good book. It's a good book if you're interested in some of the things I've been talking about in recent episodes as regards protectionism and international trade. This is, I would say, the most important book that you could have on your bookshelf if this is a topic that interests you. It's much more recent and uses much more up-to-date economic language and really tries to get in and examine why free trade fails and why and how protectionism works. So there's a little more hard economics in here. It does have some history as well. Most books on this topic do take some time to talk about the history of trade, and it has a lot of tangential components as well. Like there's a lot of what's the chapter 1 bad arguments for free trade. So it looks at the various arguments in support of free trade and says, why are these not right? Why are these not viable? And it looks at a lot of potential. There's a chapter 4, critiques of free trade to avoid. So some examinations of the various ways in which free trade has been critiqued, and why those critiques of free trade are not necessarily the correct approach. They're not strong enough critiques of free trade, although I think they can be made, and I think that they are of some value, but there are some holes in those arguments, and it's important to look at the various arguments against free trade and say, are these the best arguments that we can make? And that's what Fletcher does in this book. He looks at some of the better arguments against free trade, and it's really solid. I think he doesn't get into some of the stuff that I had talked about in regards to the elasticity of supply and demand and who the burden of the tariff falls on, the consumers or the producers. He doesn't really get into that as much, which I wish that he had, but he puts forward some other arguments that are really solid, and I'm going to get into that a little bit in my review. Like all of my reviews, I'm going to be reading a couple of sections of the book and providing some feedback to that. But there's a lot in here, so if you're interested in this topic, don't just take this podcast as sufficient. Get your hands on this book and read it cover to cover. I've read this book twice, actually, and it's just very good. So without any further ado, I'm going to get in here and start reading some of the book. In particular, I want to look at Chapter 2, Deficits, Time Horizons, and Perverse Efficiency, when he just kind of explains the basics here of how free trade really works. Not just how it's described, but what is really going on. And here he says, quote, "The trade deficit is the single most important statistic of America's trade problems. But because free traders are so adept at explaining why it supposedly doesn't matter, it is essential to understand once and for all why they are wrong. It is not a mere accounting abstraction, as one prominent free trader has called it. Luckily, this doesn't require any particularly sophisticated economics, only a solid grasp of some basic definitions and chains of reasoning. Time horizons work the same way. Although not a common part of public discussion, they are a crucial part of the conceptual framework that we will need to reason our way out of free trade problems. And by putting trade deficits and time horizons together, we can make sense of exchange rates and their manipulation. To understand trade deficits, just think through the logic below step by step. Step 1, nations engage in trade. So Americans sell people in other nations goods and buy goods in return. Goods in this context means not just physical objects, but also services. Step 2, one cannot get goods for free. So when Americans buy goods from foreigners, we have to give them something in return. Step 3. There are only three things we can give in return. 3A, goods we produce today. 3B, goods we produced yesterday. 3C, goods we will produce tomorrow. This list is exhaustive. If a fourth alternative exists, then we must be trading with Santa Claus because we are getting goods for nothing. Here's what 3A through 3C above mean concretely. 3A is when we sell foreigners jet airplanes. 3B is when we sell foreigners American office buildings. 3C is when we go into debt to foreigners. 3B and 3C happen when America runs a trade deficit. Because we are not covering the value of our imports with 3A, the value of our exports, we must make up the difference by either 3B selling assets or 3C assuming debt. If either is happening, America is either gradually being sold off to foreigners or gradually sinking into debt to them. Xenophobia is not necessary for this to be a bad thing, only bookkeeping. Americans are poorer simply because we own less and owe more. Our net worth is lower. The situation is also unsustainable. We have only so many existing assets we can sell off, and we can afford to service only so much debt. By contrast, we can produce goods indefinitely. So deficit trade, if it goes on year after year, must eventually be curtailed, which will mean reducing our consumption. Even worse, deficit trade also destroys jobs right now. In 3A, when we export jets, this means we must employ people to produce them. And we can afford to because selling the jets brings in money to pay their salaries. But in 3B, those office buildings have already been built, possibly decades ago, so no jobs today are created by selling them. And in 3C, no jobs are created today because the goods are promised for the future. While jobs will be created then to produce these goods, the wages of these future jobs will be paid by us, not by foreigners. Because the foreigners already gave us their goods back when we bought them on credit, they won't owe us anything later, so we will be required, in effect, to work without being paid. This situation isn't only a problem for America. This sort of debt burden is something heavily indebted third world countries, laboring under debts piled up by past, frequently dubious regimes, often complain about. They sometimes see international debt as a new form of colonialism, designed to extract labor and natural resources without the inconvenience of running an old-fashioned pith helmet empire. This is why they hate the International Monetary Fund, which administers many of these debts after they have been junked from the private sector through bailouts. The above facts are all precisely what we should expect, simply on the basis of common sense, as there is no something for nothing in this world. And that is what the idea that trade deficits don't matter ultimately amounts to. There do exist, however, ways of shifting consumption forwards and backwards in time, which can certainly create the illusion of something for nothing for a while. This illusion is dangerous, precisely because the complexities of modern finance and the profitability of playing along with the illusion while it lasts both tend to disguise the reality. Most of these complexities amount to ways of claiming that the wonders of modern finance enable us to either borrow or sell assets indefinitely. But as long as one bears the above reasoning firmly in mind, it should be obvious why none of these schemes can possibly work, even without unraveling their details. These financial fairy tales usually boil down to the fact that a financial bubble, by inflating asset prices seemingly without limit, can, for a period of time, make it seem as if a nation has an infinite supply of assets appearing magically out of thin air, or a finite supply of assets whose value keeps going up and up. These assets can then be sold to foreigners, and because debt can be secured against these assets, debt works the same way. Thus, a succession of financial bubbles in America since the mid-1990s in new economy stocks, real estate, derivatives, commodities, and the broader stock market have helped us keep running huge trade deficits. To a significant extent, we bought imports with bubble-inflated stock, junk mortgages, bonds doomed to melt with dollar, and other financial tinsel. Even assets that were not themselves dubious had their value propped up by a general buoyancy in the financial markets that was of dubious origin." End quote. Okay, so there's the basics right there. I want to jump back to the real beginning point here. He says, step one, nations engage in trade. Americans sell people in other nations goods and buy goods in return. Okay, so we're selling them things and we're buying things from them. Step two, you cannot get goods for free. In other words, here's where we come down to the difference between goods and money. Money doesn't have any intrinsic value of its own. People don't want to just accumulate money for its own sake. They want it because they can then exchange it for stuff. And it's the stuff that they want for its own sake. So when we buy widgets from China and we give them $1 million for these widgets, they don't want that $1 million. It's of no use to them. They want to turn around and get $1 million worth of knickknacks from the United States. And if we don't give them the knickknacks, then what are they going to do with that money? They don't want our knickknacks now, let's say. They sell us this stuff, and under perfect circumstances, they sell us and we sell to them and everything clears. And if they're selling us stuff, but they're not buying anything from us, then we have what's known as a trade deficit. In other words, we're importing a lot more stuff than we're exporting. We continue to have this trade deficit. We've got all of these imports, all these foreign-made products coming into this country that we're buying, but we're not able to sell them anything. So our factories are sitting idle, not producing the objects because we're buying stuff from overseas and we're not selling it, okay? So then they have this money that we've used, and they don't want that money. So as he says here, they want one of three things. There's only three things that we can give them in exchange for the stuff that they've given us. Money's not one of them. Money alone is not really one of those things. We're going to give them either goods we produce today, goods we produced yesterday, or goods we will produce tomorrow. And when he says goods we produced yesterday, I would even expand that to say natural resources. And land is an important one. We didn't produce land yesterday, but we have a finite amount of land. And if we don't sell them our knickknacks, they might just say, well, we don't want those. We don't have any use for what it is you produce. It's too expensive for us to buy. For whatever reason, they don't want it. But we'll take that, 1,000 million acres of farmland that you have instead. That would qualify under 3B, although we didn't produce the farmland, so to speak. It's still one of our assets. The point here is that they're buying our assets. They're buying our assets rather than the goods that we produce. And then 3C would be the goods that we will produce tomorrow. So this is where they say, well, okay, we don't want your American knickknacks. However, we may someday want something from you. So what they'll do in that case is they will buy various sorts of debt. And this is like they're buying treasury bonds. They give us back the money that we gave them for the stuff, and instead they sit on the treasury bonds. And they say, basically, at some point in the future, we're going to cash these in, we're going to take the money, and we're going to buy things from you then. And so this creates a demand for American debt. And the truth is we wouldn't be able to go into as much debt as a nation as we're able to go into if there wasn't this demand for debt. So that's something to consider. And if we get the stuff now, like if we consume now, but we're not building things to give to the foreign countries, but we're consuming the things that we got from them, then essentially we're not working, we're just consuming. Insofar as if you look just at that component of the economy, we're consuming the things that we've gotten from them, but we're not producing the things that we give to them, and so we're just consuming without working. And then the flip side of that comes down the road. When they give us the money and we give them the goods. Now, at that point, we're going into the factories and we're working and we're building things and we're giving it to them, but we're not getting things from them because we've already gotten them at a previous point in time. Now, there might be a cash infusion into our economy when they, cash in those treasury bonds and they give us the cash in exchange for the goods. But you must understand that if a foreign nation infuses $10 million into our economy by buying things from us, our nation has not gained in wealth. We've just got a larger money supply. So what we've done is we've gone to our factories, punched our time cards, and worked, and the nation as a whole has not gained anything. The objects we produce get shipped off to another country, and we don't get anything from them. So it becomes the flip side. Today we consume without producing. Tomorrow we produce without consuming. Do you see? So those are the only options. And the only good option is the first one. We give them something in exchange for what they've given us. When we sell off our assets in exchange for the goods that we've gotten, or when we go into debt for the goods that we've gotten and assume that some other future person will produce the goods to offset what we have received, those circumstances are not as good. They can be very damaging. So moving on from there to the next section, when he kind of starts to talk about some of the weaknesses of free trade, why free trade is not to our advantage to the effect that it's sometimes presented as. So let's look at what he says here, where he says, readers with a free market bent may wonder how all the above unpleasant outcomes are possible in a capitalist economy. They may suspect that there is some free market comeback, which proves that the above problems aren't really problems at all. After all, doesn't the free market guarantee appropriate economic decisions? Isn't that a basic axiom of capitalism? Well, no, not absolutely. The root problem is simple. When free market economics says free trade is best for our economy, it takes no position on whether this is best in the long or the short term. In fact, free market economics takes no position on whether any policy it recommends is best in the long or the short term. It treats short versus long-term well-being as an arbitrary, consumer-driven preference, like whether the economy should produce pork or beef. Some policies deliver the best short-term results, others the best long-term results, but it's an arbitrary choice about which we care about more. Free market economics certainly does not say that we ought to prefer long-term well-being, and it has no invisible hand that will push our economy toward an optimal time horizon, the way it will push prices to those that match supply with demand. The technical way of saying this is that free market economics treats the time discount on consumption as an exogenous preference. An exogenous preference is one brought to economic life from outside, like the fact that Frenchmen prefer wine and Germans prefer beer. Time discount on consumption is a reflection of the fact that economics doesn't literally deal in time horizons. Time horizons are the idea that outcomes matter up to some point in the future, the horizon, and then don't matter after that. Instead, economics deals in time discount, which is the idea that the further into the future an economic event is, the less it means today. This is the basis of interest rates, among other things. If you lend me money today, and I promise to pay you back later, the longer you have to wait, the more interest you'll demand in return. So treating the time discount on consumption as exogenous means that while free market economics can give us lots of advice about the most efficient way to produce whatever it is we want, it cannot tell us what we ought to want or when we ought to want it in the first place. There is no way to evade this problem with minor technical adjustments, as the entire logic of free market economics is explicitly set up this way, baked into its mathematical structures from the very lowest levels. As a result, we're going to need to change that economics a bit to find a solution. How does all this apply to trade? Try this small thought experiment. Imagine two neighboring nations, between whom trade is forbidden. Make one a decadent nation, which prefers short-term consumption. make the other a diligent nation which prefers the long-term variety. The difference between them, of course, is time discount on consumption. In economic equations, this is usually designated with the Greek letter rho. A higher value of rho means one is more short-termist because one discounts the future more aggressively. Think of rho as a measure of impatience. Now, lift their protectionist barriers so the two nations can trade, and let them lend each other money and sell each other assets so they can run deficits and surpluses. Then see what happens. Standard mathematical models of trade, accepted even by free traders, can then be used to run out various scenarios of what happens next. One scenario, in particular, is very interesting. In this scenario, the decadent nation maximizes its short-term consumption by buying all the imports it can get. So it buys all it can afford with both its exports and by assuming debt and selling off assets. In the short run, both nations are happy. The decadent nation is delighted to be able to consume more right now, and the diligent nation is delighted that its neighbor has expanded its range of investment opportunities, which will enable it better to accumulate wealth and consume more later. In economic language, both nations have maximized their utility, the odd word economists use for happiness. So according to free market economics, both are now better off. This outcome is also efficient, as free market economics understands efficiency, and agrees with the core libertarian intuition underlying that economics. More freedom makes people more able to better themselves. So, is free trade vindicated? No, because then come the consequences. The increased well-being of both nations, as they define it, decadently or diligently, depends on the ability of the decadent nation to borrow and sell assets, and it cannot do this forever. Eventually, when it exhausts its ability to sell assets and assumes debt, it ends up poorer than it would have been if it had not had free trade with its neighbor. Because it depleted its assets and saddled itself with debt, it must now divert money from its own consumption to give to its trading partner. This outcome should make clear the answer to the question that haunts all criticism of free trade. How can reducing people's freedom possibly make them better off? The answer is when they would use short-term freedom to hurt themselves in the long term. The citizens of the decadent nation would have been better off if restrictions on their ability to trade had prevented them from being quite so decadent. Trade restrictions for them would be like restrictions on an heir's squandering his inheritance. The citizen's inheritance is the entire accumulated wealth of their country that can be sold off to pay for imports, plus its entire debt-servicing capacity upon which debt can be floated. The math actually reveals that under these conditions, outright Las Vegas decadence is not necessary for there to be a problem. It reveals that under free trade between nations with merely different time discounts, the nation with the higher discount, more impatient, will tend to maximize present consumption by having past generations who produced the assets that can be sold off, or future generations who will service the debt pay for present consumption. Various factors can interfere, but that's the underlying dynamic. The fact that two separate societies are involved is key. If the decadents in a society can borrow only from diligence in the same society, then every borrower creates a lender in the same society, keeping society as a whole in balance. So no amount of decadence, whatever other problems it may cause, can reduce that society's total net worth or future consumption possibilities. But if members of a society can borrow from outside that society, then it can. Worse, things spiral out of control, giving the self-reinforcing way in which social and cultural validation of behavior creates more behavior, then more validation, and so on. So it matters whether people engage in economic relations with compatriots with whom they share a social and cultural system, or with foreigners with whom they share only arm's-length economic relations. The profoundest fact here is actually that this entire mess is efficient, as free market economics defines efficiency. This explains why free trade's dangers in this regard have mostly been ignored by economists. Within the rigorously logical, albeit perverse, assumptions of mainstream economics, it is merely a mathematical curiosity that free trade can make a nation worse off by seducing it into decadent consumption. It wanted a short-term consumption binge. It got what it wanted. What's not to like? The problem has been defined out of existence at the level of basic premises. End quote. All right, so that's a super important section there when it talks about two hypothetical nations. And one nation is decadent, one nation is diligent. So one nation wants to consume today, and the other nation wants to consume over the long term. One nation is concerned with its long-term viability. It wants to, it's willing to lend money, let's say, rather than consume today. It's willing to lend money with the assumption, of course, that it will be paid back so that it can consume tomorrow. And it will gain interest so that its consumption tomorrow will be greater than its consumption would have been today. This is a nation or a society that is planning for the future. The others is the decadent society that wants to consume now and doesn't want to wait to consume later. A country or nation that wants to consume now isn't going to lend its money. It isn't going to save its money. It's going to borrow money from the future. It's going to sell off its inheritance from the past, its office buildings, its land, its assets, its ports, its infrastructure. It's going to sell these things off, and it's going to borrow money from the future because it wants to consume today. And that's self-destructive. And it may be that they have achieved their utility. This is the problem with free trade, is that it assumes that people know best and are going to act in the best interest of the nation. It assumes there's the statement has been made that each person acting in their own best interest, presumably, and the whole nation of people all acting in their own best interest, then the end result will be the best interest of all of the people in the nation, aka the best interest of the nation. But this assumes that people make good decisions. Now, there's sort of the problem. People don't always make good decisions. And especially when you consider that they have several things to concern themselves with. I might want to consume today because I don't care about my kids or my grandkids. For instance, why would somebody leave anything to their kids? Why would someone leave their house or the money that they have in the bank to their kids? If they're acting truly in their own best interests, then they're going to spend that money. They're going to go on the cruise. They're going to go on the vacation. They're going to spend their money to consume and to enjoy the fruits of their labor today, and they have no real self-interested need or desire to pass anything on to their kids. But a nation depends on continuity across generations, so that the things that we've been given by our forefathers are not squandered, but are preserved and passed on to future generations. And that is outside of the bounds of people acting purely in their own self-interests, because they have some sense of loyalty to their family, they have some sense of loyalty to their nation, and some amount of consumption, some amount of activity is diverted away from their own immediate interests to the interests of the nation and the interests of future generations. And the problem, to some extent, is that people are not always to be trusted to make the best decisions. And if I'm concerned with the future of my nation, then doesn't it behoove me to put restrictions on my next door neighbor and his ability to spend off all of his inheritance and leave nothing to his children? Because then his children will be poor and will be coming knocking on my children's door, looking for something to eat because they will have acquired nothing. If we have to work together to preserve the future generations. We can't just say, I'm going to do my part to leave something to my kids, and everybody else's kids are on their own. Because the nation is comprised of all of the people in the society. They all have to have some amount of concern for the future. And the simple fact is that trade regulations prevent decadent nations from indulging in their decadence. So it is a restriction on other people's freedom, but it's for their own benefit. And I know that's something that probably rubs conservatives the wrong way, especially if you're more of the libertarian-minded conservative. You don't want the government imposing these policies for your own good. It's a scary concept. But the truth is, if the leaders of the nation recognize the decadence of the population, and if the leaders of the nation recognize the damaging aspects of that decadence, they, as stewards of the nation, are well within their rights in curbing the decadence. As he says here, he says, how can reducing people's freedom possibly make them better off? And the answer is when they use short-term freedom to hurt themselves in the long run. In other words, is it even really morally correct to enable a nation to borrow from future generations? Those future generations have not agreed to take on that debt. It's imposed upon them. We borrow today so that we can consume today, so that we can pass the debt on to the future generations and they can figure out how to deal with it. That seems extremely immoral, and it also seems extremely destructive to the future viability of a nation. And in that sense, it really needs to be curbed. The nation can't borrow from future generations like that. It's self-destructive behavior and simply should not be allowed. And there should be mechanisms in place to prevent it. And one of those mechanisms is restrictions on international trade, because international trade, as in the example that he laid out, international trade, international borrowing, selling off of assets to other societies and other nations is self-destructive behavior. So let's move on from there. So the next part I want to look at is when he talks about comparative advantage, the theory of comparative advantage. He lays it out really well, I think. And so I want to read where he talks about comparative advantage. He says basically that free trade, the theory of free trade rests upon the theory of comparative advantage of David Ricardo. And he says that if the comparative advantage theory isn't correct, then free trade falls apart. If it is correct, then free trade stands. So he lays out the theory of comparative advantage pretty clearly, and then he points out some reasons why it's not valid. I'm going to read to you the section where he explains comparative advantage, but I'm not going to go into detail into his dismantling of the theory of comparative advantage. I'll briefly go over it, but if you want to get the nitty-gritty of the problems with comparative advantage, you're going to have to pick up the book. I'm not going to go into all that detail on his dismantling of comparative advantage, but it's very effective. So looking at the theory of comparative advantage, he says, quote, "The theory explained in this chapter is false. It is the 192-year-old theory of comparative advantage, invented by David Ricardo in 1817. Ricardo was a London stockbroker, self-made millionaire, and member of Parliament who turned economist after reading Adam Smith's celebrated The Wealth of Nations on holiday. It dates from a time when most of America was wilderness. Railroads were an experimental technology, doctors still used leeches, and veterans of the American Revolution walked the streets of Philadelphia. The quickest route between the United States and China was by clipper ship, which took well over 2 months. Trade with Japan, however, was impossible, as the country had been sealed off from the outside world by the shogun in 1635 and would wait another 37 years for the U.S. Navy's Commodore Perry to open it up. Great Britain was the world's largest manufacturer and trading nation. World economic output was about 0.5% of what it is today. International trade was approximately 3% of that output, in comparison with today's 26%. It is, however, absolutely necessary that we understand this quaint and unreliable theory, because to this day it remains the core of the case for free trade. All the myriad things we are told about why free trade is good for us are boiled down to hard economics and weighed against the costs by this single theory and its modern ramifications. The rest is details and politics. If this theory is true, then no matter how high the costs of free trade, we can rely upon the fact that elsewhere in our economy we are reaping benefits that exceed these costs. If it is false, we cannot. Free traders admit this, for although other theories of trade exists, their normative content is Ricardian. The battle over Ricardianism is therefore decisive. To understand comparative advantage, it is best to start with its simpler cousin, absolute advantage. The concept of absolute advantage simply says that if some foreign nation is a more efficient producer of some product than we are, then free trade will cause us to import that product from them, to the benefit of both nations. It benefits us because we get the product for less than it would have cost us to make it ourselves. It benefits the foreign nation because it gets a market for its goods. And it benefits the world economy as a whole because it causes production to come from the most efficient producer, maximizing world output. Absolute advantage is thus a set of fairly obvious ideas. It is, in fact, the theory of international trade most people instinctively hold, without recourse to formal economics, and thus it explains a large part of public opinion on the subject. It sounds like a reassuringly direct application of basic capitalist principles. It is the theory of trade Adam Smith himself believed in. It is also false. Under free trade, America observably imports products of which we are the most efficient producer, which makes no sense by the standard of absolute advantage. This causes complaints like conservative commentator Patrick Buchanan's below. Ricardo's theory demands that more efficient producers in advanced countries give up industries to less efficient producers in less advanced nations. Are Chinese factories more efficient than U.S. factories? Of course not. Buchanan is correct. This is precisely what Ricardo's theory demands. It not only predicts that less efficient producers will sometimes win, observably true, but argues that this is good for us, the controversy. This is why we must analyze trade in terms of not absolute but comparative advantage. If we don't, we will never obtain a theory that accurately describes what does happen in international trade, which is a prerequisite for our arguing about what should happen or how to make it happen. The theory of comparative advantage has an unfortunate reputation for being hard to understand, but at bottom it simply says this: nations trade for the same reason people do. And the whole theory can be cracked open with one simple question: why don't pro football players mow their own lawns? Why should this even be a question? Because the average footballer can almost certainly mow his lawn more efficiently than the average professional lawnmower. The average footballer is, after all, presumably stronger and more agile than the presumably mediocre workforce attracted to a badly paid job like mowing lawns. If we wanted to quantify this efficiency, we could measure it in acres per hour. Efficiency, also known as productivity, is always a matter of how much output we get from a given quantity of inputs, be these inputs hours of labor, pounds of flour, kilowatts of electricity, or whatever. Because the footballer is more efficient, in economic language, he has absolute advantage at mowing lawns. Yet nobody finds it strange that he would import lawn mowing services from a less efficient producer. Why? Obviously, because he has better things to do with his time. This is the key to the whole thing. The theory of comparative advantage says that it is advantageous for America to import some goods simply in order to free up our workforce to produce more valuable goods instead. We, as a nation, have better things to do with our time than produce these less valuable goods. And just as with the football player and the lawnmower, it doesn't matter whether we are more efficient at producing them or the country we import them from is. As a result, it is sometimes advantageous for us to import goods from less efficient nations. This logic doesn't only apply to our time, that is, our man-hours of labor, either. It also applies to our land, capital, technology, and every other resource used to produce goods. So the theory of comparative advantage says that if we could produce something more valuable with the resources we currently use to produce some product, then we should import that product, free up those resources, and produce that more valuable thing instead. Economists call the resources we use to produce products factors of production. They call whatever we give up producing in order to produce something else our opportunity cost. The opposite of opportunity cost is direct cost. So while the direct cost of mowing a lawn is the hours of labor it takes plus the gasoline, wear and tear on the machine, etc., the opportunity cost is the value of whatever else these things could have been producing instead. Direct cost is a simple matter of efficiency and is the same regardless of whatever else is going on in the world. Opportunity cost is a lot more complicated because it depends on what other opportunities exist for using factors of production. Other things being equal, direct cost and opportunity cost go up and down together, because if the time required to mow a lawn doubles, then twice as much time cannot then be spent doing something else. As a result, high efficiency tends to generate both low direct cost and low opportunity cost. If someone is such a skilled mower that they can mow the whole lawn in 15 minutes, then their opportunity cost of doing so will be low because there's not much else they can do in 15 minutes. The opportunity cost of producing something is always the next most valuable thing we could have produced instead. If either bread or rolls can be made from dough, and we choose to make bread, then rolls are our opportunity cost. If we choose to make rolls, then bread is. And if rolls are worth more than bread, then we incur a larger opportunity cost by making bread. It follows that the smaller the opportunity cost we incur, the less opportunity we are wasting. So the better we are exploiting the opportunities we have. Therefore, our best move is always to minimize our opportunity cost. This is where trade comes in. Trade enables us to import bread, buy it in a store, so that we can stop baking our own and bake rolls instead. In fact, trade enables us to do this for all the things we would otherwise have to make for ourselves. So if we have complete freedom to trade, we can systematically shrug off all our least valuable tasks and reallocate our time to our most valuable ones. Similarly, nations can systematically shrink their less valuable industries and expand their most valuable ones. This benefits these nations, and under global free trade, with every nation doing it, it benefits the entire world. The world economy, and every nation in it, becomes as productive as they can possibly be. Here's a real-world example. If America devoted millions of workers to making cheap plastic toys, we don't, China does, then these workers could not produce anything else. In America, we hopefully have more productive jobs for them to do, even if American industry could, hypothetically, grind out more plastic toys per man-hour of labor and ton of plastic than the Chinese. So we're better off leaving this work to China and having our own workers do that more productive work instead. This all implies that under free trade, production of every product will automatically migrate to the nation that can produce it at the lowest opportunity cost, the nation that wastes the least opportunity by being in that line of business. The theory of comparative advantage thus sees international trade as a vast interlocking system of trade-offs, in which each nation uses the ability to import and export to shed opportunity costs and reshuffle their factors of production to their most valuable uses. And all this happens automatically, because if the owners of some factor of production find a more valuable use for it, they will find it profitable to move it to that use. The natural drive for profit will steer all factors of production to their most valuable uses, and opportunities will never be wasted. It follows that any policy other than free trade just traps economies producing less valuable output than they could have otherwise produced. it saddles them with higher opportunity costs, more opportunities thrown away than they would otherwise incur. In fact, when imports drive a nation out of an industry, this must actually be good for that nation, as it means the nation must be allocating its factors of production to producing something more valuable instead. If it weren't doing this, the logic of profit would never have driven its factors out of their former uses. In the language of the theory, the nation's revealed comparative advantage must lie elsewhere, and it will now be better off producing according to its newly revealed comparative advantage. End quote. Okay, so I hope you followed that theory of comparative advantage, and he sort of breaks it down in the sense of football players mowing their own lawns. And I'm not sure this is the best way of explaining it, but it works. So why is it that a football player doesn't mow his own lawn? If we presume that your average person who's going to take a job mowing lawns is probably like, I don't know, let's say, for example, a high schooler working a part-time job. He mows lawns on the side to bring in a little extra spending money. But, he maybe he's not a professional lawnmower. But even if he is a professional lawnmower, who is going into the lawn mowing industry and is out there physically mowing lawns? Is that the most efficient way to do it? If you consider there's also some, overhead, like maybe the person out mowing the lawns is of average physique, and there's some amount of money that has to go to pay him, then there's some amount of money that has to go to pay the overhead, to pay the person who answers the phone at the landscaping company or whatever. Now maybe you've got a football player who is in top tier physical condition and can mow that lawn at twice the speed and doesn't have to take a break and so on and so forth. So we say the football player could theoretically mow that lawn faster and more efficiently than the landscaping company or the high schooler doing it on weekends. So why doesn't the football player mow his own lawn, since he's better and faster at doing it than anybody else? The answer, of course, is that he has better things to do with his time. He has football games to play. He works a full-time job playing football, and he makes enough money doing that he's got enough spending money that he can pay somebody to mow his lawn for him. Even though he's more efficient at it, he'd rather pay somebody else the money to do it so he doesn't have to. This is comparative advantage, so that you're going to do whatever it is that you are most efficient at. If your time is best spent playing football because that's what brings in the big bucks, then that's what you're going to do. That is where your advantage lies. And so because you have a limited amount of time in the course of a day, you're not going to do all of the things. You're going to do the thing that pays you well, and all of the other things that you could be doing, you'll have someone else do those things. And nations do the same thing. Like, let's say America could hypothetically crank out more toys at a lower cost per toy than China, because we're more efficient. We have better capacity for toy production. We have a more educated populace to create the systems for creating toys. Hypothetically speaking, let's say we can make toys more efficiently than China can. However, we might have better things to do with our time. We might have more profitable industries that we can be in than making plastic toys. So our opportunity cost, if we were to make these plastic toys, our opportunity cost would be all of the other industries that we have foregone so that we can make these plastic toys. It doesn't behoove us to do that. Even if we are better at it than other people, we'll have other people do it anyway because we have limited number of hours in our day and we want to create, supercomputers or whatever it may be, rocket ships. And so we'll let some other company make the plastic toys and we'll make the other more important things. That's comparative advantage. So the entire theory of free trade depends on the absolute inviolable truth of the theory of comparative advantage. And if the theory of comparative advantage has gaping holes in it that are not adequately addressed, then it may be the case that the theory of comparative advantage is not actually completely true. And that's what Ian Fletcher is saying here. He breaks that down. He explains comparative advantage pretty well. But then in the next section, he points out, let me get here to what he calls the 7 dubious assumptions. Now, I'm not going to read this whole section here. I advise you to get this book and look at these in more detail. But he points out 7 problems with the theory of comparative advantage. And I'll just list off the headings of these different. So dubious assumption number 1 is that trade is sustainable. In other words, a country can continue trading in certain products forever. And if you have some limited resource, like let's say you have oil in your country and you build your whole economy around selling the oil in your country, and then the oil runs out, your country is screwed. So in that sense, that particular trade is not sustainable over the long term. The dubious assumption number 2, there are no externalities. Dubious assumption number 3 is that factors of production can move easily between industries. In other words, we can just, at the drop of a hat, shut down one industry and open up a new industry, and we can just switch like a light switch. But in reality, a bunch of people become unemployed. Their skill set is no longer of any value to the nation. Their resources, the assets that were used to produce the old thing, can't be immediately transformed into the sort of assets that produce the new thing, and that is a problem. And dubious assumption number 4, trade does not raise income inequality. Dubious assumption number 5, capital is not internationally mobile. That's an incredibly important dubious assumption. Dubious assumption number 6, short-term efficiency causes long-term growth. No reason to believe that. And dubious assumption number 7, trade does not induce adverse productivity growth abroad. That's an important one. If our international trade encourages China to rise to the status of an international superpower so that we're now in competition with them on the world stage for, who controls the planet, that's a sort of unwanted effect. We don't really want to help other countries build up their military capacities to the point where they can challenge us or even supersede us. There are geopolitical problems with that. And so, but I would recommend get this book and look more closely at his breakdown of the problems of the theory of comparative advantage. And then a last part here that I want to look at is where he really proposes his solution. The solution he proposes is, he calls it the natural strategic tariff. And I think he's dead on correct about this. You don't want to have this situation where all of these different industries are all sending their lobbyists to Washington. Well, we want our industry to be protected. We don't want that to be protected because we buy that. We don't want steel to be protected because we're importing steel and we want to get it, cheap. But we want, when we produce these cars, we want the cars to be protected because we don't want to have competition from foreign car manufacturers. And it gets into the politics of everything and the lobbyists and so on and so forth. And that could be a huge problem where you have this crazy quilt of different tariff rates for different things, and everything is constantly up for debate. And what he says basically is the easiest and best thing to do is to simply have one flat tariff rate for everything. No variation by industry. We're not going to try to figure out what industries need protection, what industries don't need protection. We're just going to have a flat rate, and it's going to apply to everything. And it's going to work because the flat rate will interact differently with different industries. And this applies also to what I was talking about in Henry Hazlitt's book, Economics in One Lesson, about the elasticity of supply and demand, how some industries have a high elasticity of supply, others don't, and different industries will absorb the tariff will be, the burden of the tariff will fall on the foreign producers or will fall on the domestic consumers differently in different industries. And so one tariff rate doesn't affect every industry the same way. He doesn't talk about the elasticity of supply, but he talks about other things here that are really important, where he talks about economies of scale and the cost per unit. I'm not going to get into the details of that. Again, pick up the book to get the details. But the overall view of the natural strategic tariff is this here, where he says, quote, Here's the nightmare that haunts all criticisms of free trade in this country. What if these criticisms imply that America needs a complicated, technocratic tariff policy? This seems to be suggested by the complexity of the defects in free trade, and by the fact that nations which have most successfully repudiated free trade actually have complicated, technocratic tariff policies. That would spell trouble, as the political difficulties of achieving such a solution in America are no secret. In the words of Alan Blinder, a member of Bill Clinton's Council of Economic Advisors and former vice chairman of the Federal Reserve Board, in Japan, industrial policy was and is run by a cadre of intelligent, respected, and powerful technocrats, largely insulated from political interference and acting in the national interest. The United States, I am afraid, is too democratic for that. Political considerations would quickly overwhelm economic merits. Industrial policy would more closely resemble life support for dying industries than incubation of emerging ones. It is, in fact, sorely tempting to take these political difficulties as an excuse to do nothing at all. The dangers of a special interest takeover are not imaginary, but we can't afford to quail at the challenge of making the politics work, as we are competing with rivals who have already done so. Like it or not, they have raised the bar for us. For the U.S. to concede that there exists an area of national policy this important that our rivals can master and we can't is a decision in favor of voluntary national decline. Billionaire investor Warren Buffett says that one of his criteria for investing in a company is that it must have a business that even a fool can run, because sooner or later a fool will. A similar philosophy should guide our construction of a tariff policy. We need a broad-based policy that can survive imperfect implementation and political meddling, a certain amount of which will be inevitable. We do not need an intricate, brittle, difficult policy that will only create work for bureaucrats, lawyers, and lobbyists. Among other things, a policy too complex for the public to understand will be beyond the reach of democratic accountability, the only ultimate guarantee that any tariff policy will remain aimed at the public good. One of the great puzzles of American economic history is how the U.S. once succeeded so well under tariff regimes that were not particularly sophisticated. This is where the idea of a so-called natural strategic tariff comes in. The idea says that there may be some simple rule for imposing a tariff which will produce the complex policy we need. The simple rule will produce a complex policy by interacting with the existing complexity of the economy. All the complexity will be on the economy side, not the policy side. So all specific decisions about which industries get protection, how much, and when will be made by the free market. No intricate theory, difficult technocratic expertise, or corruptible political decision-making will be required. There are obviously any number of possible natural strategic tariffs. The one we will look at here, probably the best, is actually the simplest: a flat tax on all imported goods and services. Prima facie, this is strategically meaningless because it protects and thus promotes domestic production in all industries equally. And if a tariff is going to win the U.S. better jobs, it will do so by winning us more positions in good industries. While a flat tariff will help the deficit, which is good, it would provide the same incentive for domestic production of computer and potato chips alike, so it would not push our economy towards good industries. Or would it? The natural strategic tariff is a bet that it would. The key reason is this: industries differ in their sensitivity and response to import competition. Although this is a complex issue, the fundamental dynamic is clear from the fairly obvious fact that a flat tariff would trigger the relocation back to the U.S. of some industries, but not others. For example, a flat 30% tariff, to pluck a not unreasonable number out of thin air, would not cause the relocation of the apparel industry back to the U.S. from abroad. The difference between domestic and foreign labor costs is simply too large for a 30% premium to tip the balance in America's favor in an industry based on semi-skilled labor. But a 30% tariff quite likely would cause the relocation of high-tech manufacturing like semiconductors. This is key, as these industries are precisely the ones we should want to relocate. They have the scale economies that cause retainability, high returns, high wages, and all the other effects of good industries. Therefore, a flat tariff would, in fact, be strategic. End quote. So the idea here is simply that if you had a flat 30% tariff on all goods, it would affect different industries differently, and it would not cause the apparel industry to relocate to America, because the difference in labor costs between third world seamstresses who are making t-shirts in Indonesia and American workers is too great of a difference in wages for a 30% tariff to actually relocate the American apparel industry or relocate the apparel industry back to America. However, another industry like semiconductors would have the effect of relocating it back to America, because it would respond differently to that 30% tariff. And the idea here is it comes down to the cost per unit. Something like semiconductors has a high cost per unit, and they would not be able to absorb a 30% tariff in the way that an apparel industry would be able to simply absorb that tariff. So, see, here, part of the argument that has been ongoing ever since the founding of the nation is the fact that tariffs have two different effects. One of it, which is a protective effect, and the other is a revenue-generating effect. So in the apparel industry, the goods will continue to be made overseas. It will not relocate the industry to America. The goods will continue to be made overseas, meaning the tariff will get paid. Now, whether that tariff is paid by the residents or by the foreign producers, again, that is a question of elasticity of demand. But the fact is that the tariff, a 30% tariff, would not be enough. You would need a much higher tariff to cause that to relocate to America. Another industry with a high cost per unit would in fact relocate, and so that tariff would serve a protective effect. So the tariff on the apparel would serve a revenue generating effect. The tariff would get paid, the money would go to the government, and the government would gain revenue by the implementation of the tariff. The tariff on the semiconductor industry would serve a protective function. It would protect American semiconductor industries. The tariff would not get paid because the semiconductors would not be made overseas. They would be made domestically. So that tariff doesn't get paid. So it serves a protective role. The tariff on the apparel serves a revenue role. And so the much of the debate historically has been whether we want to have revenue-generating tariffs or protective tariffs. And what Fletcher is arguing is that simply the way that the different industries have different costs per unit, they're gonna sort themselves into protective tariffs and revenue-generating tariffs. And the industries that we want to keep are the cutting-edge industries, the high-tech industries, things that we really feel should be domestic. Those will have a protective function. The other things, the mature industries that are not as critical, such as apparel, those will serve a revenue generating function. So I'm going to wrap it up at that. I have several times, and I will one more time, highly recommend that if this is an area of interest of yours, get your hands on this book and read it carefully and memorize it. No, you don't have to memorize it, but put it on your bookshelf. This is one of the most important protective theory books you will get your hands on. Thank you very much for listening, and I hope you have a great day.